Well, thanks, and let me second the welcome, and again, and give a doubly warm welcome to, first of all, Ann Manning, who's joining us as a guest damsel tonight. Ann's had among the more successful selections here over the last year and a half in the portfolio, so we welcome Ann back. And in fact, Cy Lynch said that we're probably better off with Ann tonight than him, but we just hope that everybody does okay. And again, and second of all, I'd just like to again welcome everybody that's joining us, anywhere from China to Florida to Maine to Washington to all over this great country. Have a bunch of people here. Let's get the housekeeping out of the way first. Again, we're going to talk about some real companies in real time. This is an educational demonstration. We are trying to pick companies that we think have a better than average probability of going up, but it is an educational demonstration, and absolutely no investment recommendation is intended. And again, most of you that are here tonight are very familiar with the drill. Please do your own homework. Here's a quick look at our agenda. Pretty simple agenda tonight. We just want to say welcome to everybody. We're going to go into 4 individual company selections, talk a little bit about how we've done. In any spare time left over, we'll dedicate to educational subjects or things which may be on your mind. Hugh is going to go into a little bit of an extended session on looking at return on equity, so we saved Hugh for last. So that'll serve as a bit of an educational portion for tonight's session, and we just look forward to kind of kicking around a few of these companies. Now, we were talking just a few minutes ago about there are relatively few of us in the community that bought Facebook on the day which shall live in infamy. That very weekend, I also had a physical experience that pretty much matches the image there in the upper right. I actually tripped and fell while chasing a dog that we're caring for. Belongs to our daughter, and I actually looked a lot like what you see right there. Nasty experience, but I think I can speak with authority as to what a faceplant feels like. And of course, Facebook has now gone from $38 after that first day of trading, which, by the way, is when one member of our family did latch on to a couple or 100 shares in her IRA. So she's in it for the long haul, and she just simply wants to be able to say that she bought Facebook on day one, and she wants to be talking about it very proudly 10 or 12 years from now. And in fact, I'm speaking of my wife, and she thinks that all the stuff going on in the daily news and the 24/7 stuff that Ken talks about all the time is just a bunch of hooey and a bunch of chaos and nonsense. And she basically uses the rationale that she hopes that Zuckerberg and his team will discover all kinds of wonderful opportunities, and that 10 or 12 years from now, it'll be a successful company, and that will be reflected in the share price. So no, we're not picking Facebook here tonight, but I was tempted. Here's a quick reminder about what we're trying to do. The 4 of us, along with our guests that are with us from time to time, like Ann tonight, we are trying to pick companies that have a probability of a better than average probability of going up. We do want to achieve a long-term relative return. Now, that's a relative return versus a market benchmark. In this case, we're talking about the Wilshire 5000, as shown here. We want to try to beat the long-term performance by about 5%. We'd also like to see a situation, because this is doable, it's done by many investment clubs, many individual investors who join us here tonight, of picking 60 to 70% of our selections and have them actually go up since their time of selection versus the total stock market. And some of the more successful investors in history have ranged in that 65 to 70% range, and it's a noble objective to shoot for. Here's where we stand today. We had another kind of cold month, even though the market's been cold. We were colder, and we've kind of regressed a little bit. We were over in this range last month, and we lost a little bit of ground. We're back down to a negative relative return in our just under 2 years of operation of just a little bit more than 5%. And our all-time since inception accuracy, which a few months ago was hovering around 50, has now misbehaved and gone back to the low 30s again. So we don't want to dwell on this. We just want to look forward to better days ahead. This is a graph, and it's a little bit busy, so I'll try to take my time with it a little bit, but we do want to make a point, and I have a special point to show on this graph that I want to spend just a moment tonight acknowledging. And again, first of all, anybody who's here tonight, by definition, is almost not an average investor. I'll come back to average investor in a second. But what you see here is basically a scatter chart of a bunch of different portfolios. Every single one of these dots is a portfolio. The red ones represent institutional portfolios. Now, they're either mutual funds or could be a newsletter fund or newsletter model portfolio, that sort of thing. But notice that there's just a whole bunch of red down here, in basically hovering around zero. Some not doing so well, below zero. The blue dots represent investment clubs. In fact, some of the people in the room here tonight are members of these clubs that you see mentioned here. I believe Ken was just at a meeting of the Wolves. You're basically talking about nearly 20 years of performance with a relative return in the 6 to 7 percentage point range above the general stock market. That's just awesome stuff. And again, our long-term goal, and that's what we want to emphasize here with this, is to do at least 5% better than the market. So we want to try to get above that dotted line. We're a little slow out of the gate. We're somewhere down in this range right here, but give us time. We'll be heading north as soon as we can. But the one I wanted to spend just a little bit of time, because the study was just published this past week by the research firm known as Dalbar. It's this dot over here. And it basically took a 20-year look at the actual return performance of literally thousands of individual investors and found that over an approximately 20-year period, those thousands of investors had underperformed the stock market by as much as 6%. And the only way you can do that is by basically buying high and selling low, to put it bluntly, or to have just frenetic or frenzied activity and very little discipline or a lot of bad luck. That's the only way you can get there. It's that same condition that we've talked about from time to time, that Peter Lynch used to talk about, how he had a circle of friends back when he ran the Fidelity Magellan Mutual Fund, which, by the way, is the point up here at the top. It's Peter Lynch and Fidelity Magellan, so obviously the fund did pretty well while he was running it. He actually had friends and colleagues who, as investors in Fidelity Magellan, while he's having that spectacular run, managed to achieve negative returns investing in Fidelity Magellan. Again, the only way they could have done that would have been to buy at the absolutely wrong times and sell at the absolutely wrong times, and that's just wild. So again, you're here tonight, you're not an average investor. Chances are you're among people likely to assume these type of blue dot positions up here, and we basically say, well, welcome, and we look forward to the days when we can talk about the round table up here with some of these blue dots in the middle of the screen. Here's our progression, which we'll be charting. And again, we're hoping to see this go. By the way, a month ago we were up here. So we're basically hoping to head up north over time. One last thing before we get started, just to give a little bit of context to the general marketplace. This is the graph of the median return forecast, known as MIPAR, median invested projected annual return, for the approximately 2,400 companies that we cover at Manifest Investing. That's the blue bars. Right now we're basically looking at a return of between 9 and 10%, and the reason that it's up from the lows that it was just recently is because the general market over the last month, and it's been a gruesome month. The month of May for investors has been awful, and that reduction in price leads to an inverse relationship and an increase in returns from the levels that we saw basically at the end of March. So our interpretation of the current situation for the market is we're basically somewhere hovering in the middle of this range, which literally goes back 50, 60 years as we've looked at it. And so we basically would say select well, select stocks carefully, and maybe pay a little bit extra attention to higher quality, higher financial strength, but by all means get in there and remain relatively fully invested, even for those of you practicing asset allocation and maintaining cash positions. It's not the time to have maximum cash positions anytime we're in the middle of this range. I'm going to go ahead and get us started tonight. We literally draw the batting order out of a hat typically, and I ended up first in the batting order tonight. I'm going to make the first company selection. The company is known as ABB. That is actually short for ASEA Brown Boveri, and that's a company that operates out of Switzerland and Germany. And they're literally, the best way to characterize who they are is they're kind of the European version of General Electric. They're into power, automation stuff, heavy equipment. You can see some of the snapshots from things that they work on. You see the ABB logo hanging on the side of this. That's actually some heavy equipment found, much like what would be found in a power plant. You can see here's a locomotive, that they're in the locomotive business. They also make gas turbines like General Electric, and they make an awful lot of transmission and distribution equipment for the electric utility network, the grid, that you'll hear talked about. And that's the type of equipment that you see here, the kind of stuff that you see on the top of telephone poles and then those substations in your neighborhoods. ABB makes a lot of that kind of stuff, so that's what they do. And at one time, several years ago, I worked for a division of this company known as ABB Combustion Engineering, and we built power plants. That's what we did. Where did the idea come from for this month? What I basically did is I went into Manifest Investing and I did a stock search where I searched for the top 2% of all companies ranked by projected return, the return forecast, and quality. And then I also wanted to look for the top 2 percentage points of sentiment using the Motley Fool CAPS indicator that you can do in our stock search function. And then you end up with this basic list of 8 or 9 companies. Now Ken's going to hit this one up here in a few minutes. IPC, the hospitalist company, that one actually came up out top on the screening results. But I like ABB a lot also. ABB is also kind of a concept or a play on what's going on in Europe, the recession that's going on. And make no mistake, there's basically a recession in progress all the way from as the reform broker Joshua Brown says, all the way from Beijing to Brussels to Buenos Aires. There is a recession going on out there in the global marketplace, and that is impacting the companies like ABB. Now that means that we could have kind of a sluggish situation performance-wise and fundamental-wise for the next 18 to 24 months, but this is a nice company to be in as the globe comes out of that recession, in tandem with whatever wonderful small companies that we can find coming out of a recession as that happens also. So the first one, IPCM, Ken will be covering, and let's take a closer look at ABB. Again, the General Electric of Europe. Here's a quick look at the visual analysis for the company. You can see that the top line has been a little bit bumpy, as you would expect with a capital-intensive company that's going to be vulnerable to recessions, because it doesn't have the majority of its business in the United States. The domestic recession shown here, the Great Recession, did not hit it, and there's kind of a lag or a delayed effect where it kind of took a while for the rest of the world to catch up, and it eventually did. And that's what caused the drop-off in performance in 2009, 2010. And you can see that the current situation, absent any deepening of the global recession, is pretty favorable, with analyst forecasts for 2012 and 2013 looking pretty solid. And again, all bets are off if the recession deepens, or if come June 18th, if Greece completely falls apart, could have a really nasty effect on this one. Let's take a look at the profitability analysis for ABB. You can see that the company got stung a little bit by that Great Recession, but seems to be stabilizing somewhere up in the 8, 9, 10% range for profitability. We're talking about net margin here. Net margin, so we're basically looking at a company growing at 6 to 7% based here, achieving net margins in the 8 or 9% range. So we've got one last, those are the 2 first major milestones. Let's talk about the third. This is an image taken from Morningstar.com, taking a look at ABB, and the reason I'm doing that is there's very little information available in very few places. One of the things that I found is where Value Line and some of the others might be a little bit lacking in some of the foreign company content. A lot of times Morningstar will pick up the pieces. And in this case, Morningstar provides this look at PE going back over the last 10 years or so for ABB. And what we see is kind of a picture where it would seem to make sense for perhaps something in the mid-teens to expect going forward for a company like ABB. Again, it's going to be similar to General Electric in a lot of its characteristics. So I'll kind of close with a look at our point of view slide for ABB. And again, we use this to compare the conclusions that we make at Manifest versus the individual service, the research services, and what they're thinking. You can see that we have a company that's somewhere in the upper teens when it comes to the return forecast. A good quality company, again, very capital intensive. They've got some bumps, so they don't have an excellent quality rating, but a good quality rating. A financial strength rating of 70, that's basically comparable to a B++. They do have some debt. That's their effective interest rate there at 6.24%. So we're talking about a company we've made the assumption of 6.5% growth, 8.9% profitability at a PE of 16. That's what delivers this projected annual return of about 19%. Again, we can do some of the side-by-side comparisons. You can see that Morningstar checks in with a financial health rating of A. Very strong company globally. Their growth expectations are actually a little bit higher. Their profitability is pretty consistent, and this also gives us the opportunity to talk about the situation where sometimes S&P will have a fairly different opinion, in this case a hold, versus this strong buy from Morningstar. And you can see here's one of the core reasons for that. The S&P PE being used in their calculations is down around 11 times earnings. For Morningstar, they're at 18. That's a pretty big difference. I'm glad to not be as high as some of them. And so we can see we have a little bit of a difference of opinion between Morningstar and S&P. I will confess that in many times when it gets a little bit dicey, especially when the company has some cyclical tendencies or characteristics, that I tend to pay a lot more attention to S&P under those conditions. So this one gives me a little bit of the heebie-jeebies, but not too bad. Notice that Value Line has no coverage for the company. One of the reasons I want to bring that up, though, is we have noticed the Value Line has been increasing their coverage of foreign companies. For example, they added Nestle to coverage recently, and there have been a few others recently. We hope that that trend continues. Love to see more coverage from Value Line of the non-domestic companies. For those of you that do the technical analysis stuff, this is a company that is at they're down at a relative strength index of around 30, which means that they are potentially oversold. That's a nice position to be into and taking an entry-level position. The longer-term sentiment is bullish on ABB with a price objective of 31.5. You can see that Standard & Poor's, even though they have a hold rating on the company, the current price is down around 16. They do have a 12-month target of 21. That would be a 30% increase in 1 year. I'll take that if it happens. Let's hope for the best. And you can see here that the foolish sentiment by the All-Stars at the caps is 98, so pretty good stuff. And I'm going to go with ABB for this month's selection for the round table.
Mark, we have a question from Susan. She'd like to know where ABB is traded.
Well, they are traded as an ADR in New York. I believe they're traded predominantly on the exchanges in Berlin and Sweden, and probably Switzerland also. I do not know exactly where they're traded internationally, but you can buy it as an ADR.
Okay, and that means right on the New York Stock Exchange then, right?
Yep. Any other questions?
No other questions, Mark.
Okay, well, I thought we'd just take a quick look at the portfolio before we turn Ken and Ann loose. The public dashboard for the round table is up at the top there, and we're not going to dig into this too deeply tonight. You can go and take a look at any previous selections, and we'll be updating it after tonight's selections by going to that public link at the top of the chart. Again, the PowerPoint presentation will be available in the Manifest Forum when we're done also. So if we go through some of this stuff quickly, you'll know that you can always lay your hands on it later. As we were mentioning, the median return forecast, or the median projected annual return right now, is approximately 9%. And I'm just going to do a real quick report card tonight. We have enough par, enough projected annual return in the overall portfolio, enough quality, and we're right in that target range for growth also. And you can see over here from the pie chart, we have a fairly good distribution of medium-sized companies, smaller, faster-growing companies, and stalwarts or larger companies. Pretty good spread, even though we do not sit down and actually engineer this. This is just something that happens fairly naturally with the picks made by the roundtable participants over time. When it comes to sector diversification, again, I think many of us simply go where the opportunities are. The opportunities in the last 18 months or so have been manifested in both technology and healthcare. Our friend Hugh has gotten a little bit creative and a little bit, I would say, speculative with some of the financial selections, but again, he's in it for the long haul. And again, pretty good sector distribution there too. Any questions on any of that, Ken?
Nope, we're flying pretty smoothly right now, Mark.
Okay. Just a quick look at the portfolio, and again, it's available continuous 24/7, so you can take a look at it any time. This is ranked by the largest position. You can see that the largest position is Walgreen. He's going to actually add to that tonight. But the top 16 holdings by percent of total assets are shown here. And you can see we're ready for many of these at the top to go ahead and do their magic and take off and go up. We're ready. Here's that same list, only in this time it's sorted by the return forecast and projected annual return on the right, just so we can try to identify where some of the higher opportunities are. And if I had to place a guess, I would guess that some of Ken's interest in IPCM tonight stems from right there. The fact that it's sitting right in that zone. And I'd also guess that Ann is compelled by the fact that Apple is only 2% of the portfolio and also has these characteristics. So you can see we're accumulating companies for the roundtable that happen to be fairly small positions at this point in time, but with fairly strong characteristics. So good picks going forward. And then we'll leave the portfolio with one last slide, and that's to check to see if there's any obvious challenge or companies that we should have a discussion on selling. Any of you guys want to chime in on any of these? I mean, they are below my par, but I don't consider any of these to be hair trigger sales by any stretch, especially considering that we have pretty solid projected return for the overall portfolio of 16%. Any thoughts on TJX, Ken, or anything else that you may have looked at?
Well, Mark, you know that I try to stay pretty disciplined, and as long as that bottom set of numbers is where I want it to be, I don't have any problems holding TJX in the portfolio. I guess that I'd like us to do a little bit of discussion in the near future about what we're going to do with the money once we close the position out. Will the money just freeze itself, or what will happen as we're building this portfolio? I'm not quite clear on the rule for that yet, so we'll have to talk about that a little bit.
Okay, we can. We don't need to do it tonight, but it's basically treated as a distribution, and we lock in the position of the performance over time, but we can do that. Anybody else have any thoughts?
I think the power in some of these has improved. That's probably due to the market not doing as well this month as in the past.
Well, in the case of Costco, Hugh, you may remember 3 or 4, maybe even 6 months ago, Costco was at the bottom of this list. Mm-hmm. And we basically went through a discussion of why we weren't selling it. And, they basically have continued to deliver strong results. Now, the price has been a little bit stagnant, so the combined effect of the stronger results and the more sluggish stock price has resulted in what we see here, this pretty favorable situation for the par. And again, guys jump in and correct me if I'm wrong, but I really think this is what Nicholson For those of you that don't know, we're referring to George Nicholson, one of the founders of the National Association and grandfather of the Modern Investment Club movement. He used to talk in terms of if you really had a high-quality, exceptional company with excellent management, you really didn't want to be in too big of a hurry to sell it if it had a sufficiently high growth rate. And you basically gave them a longer leash. And I think this is a perfect example of that with Costco. Now, in the case of TJX, that has doubled. That's a $1,000 position. I mean, and I don't think we should be married to that one. And I mean, if that projected return gets any lower, I think we do have to have a substantive discussion about taking it out of the portfolio and basically locking in a victory. Even though Ken doesn't need any help, he is leading the charge here.
Well, I think
any other thoughts?
Discussion later on about what to do with the cash that ends up getting freed up as a result of the sale.
Yeah, we'll have to cover that. We probably should talk about that next month because we actually are not doing it that way. All right. Let's go ahead and press on then. Turn to our rescuing damsel, not rescued, rescuing damsel, Ann Manning, and ask her to go ahead and talk a little Apple with us.
Okay, Mark, thanks for having me, I think. Obviously, Apple's very well known to everyone. I don't really need to get into what they do or how they operate or anything, but I did want to give you a little bit of flashback and make us realize how long Apple's been around. The first Apple computer was introduced in 1976, which has been 36 years. The first Mac was introduced in 1984. Believe it or not, the first iPod was 2001, the iPhone is 2007, and the first iPad was 2010. And the latest version of the iPad in March had already sold over 3 million sets of that. So obviously they're doing something right. As you can see on the value line page, this was from April the 6th. The price was $614.48. The high for the year was $644, so even on this date it was down. Today's closing price was $572.27. So today's closing price is about 11% drop from the high of $644. As you can see on the left side, their projections are anywhere from 25% return to 16%. I personally like to go more on their lower side when I do an SSG. If you saw down in the commentary, they are going to be launching the latest iPhones overseas this year and next year, notably in China. They will be sending that. They should be getting quite a few more sales from that. And I'm sure everyone knows they're announced they're going to start having a dividend. It'll be $2.65 a share. They're also going to be buying back $10 billion worth of stock starting next year over the next 3 years. As you can see, they're projecting their earnings to be $70 from 2015 to 2017. And I find it interesting that Value Line is saying that they're going to have 975 shares outstanding when they have said that they're going to be buying them back. So I would think that should be less.
Probably will on the next report, Ann.
Yeah. So, and you can see they're projecting their sales to be $250 million over the next 5 years. Considering where they came from, in the last 5 years, that's a tremendous jump. Mark, if you could go to the Yahoo Finance. These are the analyst estimates coming up for the next year. As you can see, they have gone up in their trends in the last 90 days. And they're predicting a 19.70% annual growth estimate over the next 5 years. So that's I believe it was Value Line was their low projection was 16%. So they're actually a little bit more optimistic, which is not unusual for analysts. Okay, Mark, if you could give me, oh, you got it. Okay, here is the Manifest Investing's equity analysis guide. As you can see, they're projecting a 21.2%, and obviously the quality is very good. And this is today's closing price. And if you'll look down, they're projecting a 16.3% sales forecast with the projected average price of $1,418.73. Mark, can you show the Chronicle at the bottom, or do you have that?
Nope, we'll have to do that if we switch to your screen, Ann.
Okay, well that's okay. I can just tell you it's the projected relative return is in the 10% range, which is what we're looking for. Okay, if you could go to the Eagle.
Oh, we need to switch to your screen now for sure.
Oh, okay. All right.
We'll switch to you as a presenter.
Okay, how am I going to do this? Show my screen?
Yep.
Okay. Do you have me yet?
Yep, we're looking fine.
Okay, all right. If you take the Manifest Investing's numbers here and put them in an Eagle, let me show you what you're going to get here. And they're projecting an annual return on this at 20.3%. As you can see, the 16.3, which I pointed out on the equity guide, and they have an earnings per share going up to 78.82, which was higher than Value Line's. Okay. And the RSI right now is the relative strength index is about right at 60, and it was as high as around 86, so it is down from its high. Okay, now I'm going to show you my SSG.
Yeah, and back when it got up into the 650, 660 range, we actually pointed that out and said I wouldn't run for the hills, but I wouldn't be surprised to see some air come out of that price. And you know, we said that with some Apple people in the audience threatening us, but sure enough, it did. It has to give up some momentum at some point.
Right. Okay. As you can see, it is up straight and parallel. You can't get much straighter up than this, and you can see from the quarter ending 3/31/12, they had an incredible change in sales and earnings per share. Okay. Hang on just a second here. Okay, I wanted to show you if you look at this, the quarterly trend analysis, you can really see what the numbers are from the graph. And I always like to look at this because this is the last quarter where you can see they went up the 92% change in EPS and the 58% change in sales. So you can see where they've come from in the last few years, and a lot of that has been from the iPhone and the iPad. Although their Macs and Apples are still selling, a lot of their sales right now are from the iPhones and the iPads. As you can see, their pre-tax profit is still good, and their return on equity is excellent, and they have no debt. One thing I decided to do with this was to be a little bit different than what we normally do. Instead of telling you this is these fabulous numbers and what it could happen, I wanted to take it in what happens if Apple went off the rail. As you can see, what they've done in the last few years is 38.6% sales growth. But if I back it up, before they introduced the iPhone, which was in 2007, they were still doing 38.2% sales growth. So anyway, like I said, I wanted to go at this differently tonight and say, okay, what if they didn't do that kind of numbers? So I put in 12% growth, which everybody is saying 16 to 20% growth. So if we put in 12%, and I just took the PEs from the last year, the high and low, and put it in for the future high and low, and we still come up with almost the same amount as Value Line's low projected amount. And if you get down here at the bottom, even if you say they did really bad compared to what they've been doing, you'll come up with anywhere from 10.8 to 15.5% return. So I'm thinking that they're going to do pretty good. If they've been doing that kind of business for the last few years, I still think they're going to continue at least for the next couple of years doing the kind of business they've been doing. So I didn't think I'd ever recommend buying a stock that costs $572 a share, but I am. So that's my presentation.
Well, thanks, Ann. I'm sure one of Ken's only regrets is that he didn't come back and buy Apple. I believe he selected it for the roundtable approximately a year ago, and he wishes he'd have come back for a repeat second course.
2 or 3 times, yeah.
Right, exactly.
And we have a question. Can you tell us where you got the $449.80 low price from?
Okay. I choose 80% of the current price.
Okay.
That's just what I choose.
Okay, thank you.
So, okay, so I have a question for y'all. Was that helpful to see what would happen if they didn't do as well, as opposed to just giving you a glowing report, this is what they're going to do?
Well, I think there's a couple things at work here, Ann, and we can spend just a moment. The profitability of the company has gone up by their product mix, and we can take a look at that in a second. But the other thing is we're not talking about a company with a 40 or a 50 PE. We're talking about a company that's got what? The current PE is right around 20.
Yes.
Depending on how you measure it, it's high teens. And again, this is a cyclical company, and it could easily justifiably drop down into the low teens. But again, you're not talking about falling from 40 to 10. You're talking about falling from 18 to 14. That's a whole different trip from my perspective. One thing I'd like you to go ahead.
Mark, the current PE is only 13.7 right now.
Oh, I was looking at the wrong place on there. That's right. So, yeah, I mean it doesn't have, even though it feels like it's elevated, it does not have as far to fall as, one of those go-go stocks. Ann, could you click on the pink box in 2A just to demonstrate? Because you were getting close to go up to the 2A box.
Okay. Is that what you wanted? No, not that one.
Next one up.
Okay.
And this is kind of the answer to your question if they were to go off the rails, so to speak. Because take a look at how that profitability has improved. If they really went off the rails with one of their current highly successful products, you'd see a compression here. The growth rate's going to obviously come back too, but what happens to this company if it does return to 20 or 15% net margins or pre-tax profit as you've got shown here? And that's kind of the question, because look at those numbers back before they started introducing those products. They were just a computer hardware company barely making any profit.
Right.
And they'd have to mess up pretty bad to return to those days, in my opinion.
Well, that's what I felt like. But I just wanted to go in that direction just to say, you know, what if they did go off the rails? Yep. Would it still project you to make money?
Good job. Well, thank you very much, Ann. Any other questions, Ken? Are you ready to zoom to your part?
Ready to go to my screen now, Mark? Sure.
Okay, let me go ahead and switch. Again, thanks again, Ann.
Well, what I've done for my section is to start with a Manifest Investing screen. And from the home page of Manifest Investing, I looked over on the right and I saw a listing of public dashboards, and one of them said More, so I clicked on More, and down around near the bottom of the More list is this round table dashboard. So that's what I brought up to start my presentation with. And I looked at this round table dashboard, and I saw all these with yellow backgrounds that we've already chosen. Remember that a yellow background can mean that it's a little bit above the sweet spot, or that it's a lot above the sweet spot and maybe getting too good to be true. I think old RIM maybe fits in that category up there. But I'm looking near the break point here at the top of the sweet spot for par, and the bottom of the category where it's too good to be true. And I'm kind of shopping in this particular area. I'm keeping in mind the percent of portfolio in that range, that middle range right there, and my eye focused immediately on IPCM. I happened to run, and Mark and I didn't talk about this, but I ran a screen very similar to the screen he ran, looking for a combination of quality and return, and IPCM came up on that screen as well. Mark showed you a very similar screen where IPCM came up at the top. I think I only chose this stock maybe a month ago, maybe 2 months ago, but I'm going to put my money back in this stock a second time because it is a fairly small piece of the overall portfolio. People always ask me, where do I go to research these small stocks? And I want to demonstrate the problem you have with small stocks like this, and why, frankly, you should stay away from these stocks if you're not prepared to do a lot of extra reading. Let's start by looking at the Manifest Investing site on IPCM to start with. If I want to stick just with Manifest, I get an excellent quality and excellent par, and it's already telling me things that I can put with my SSG to maybe make some decisions. For example, Mark's chosen, after looking at the analyst reports, Mark's decided that 17 plus is a fairly decent growth forecast with an average PE ratio of 22. Well, I go immediately to my toolkit. Here it is. And I'm looking at 17. I've put on the analyst expectations for the next few years. And when I use 17 down in my boxes here, my trend lines get a little bit ahead of the expectations themselves. So I'm choosing 15% for my sales. And because I don't have any other numbers to essentially go on for the moment at least, I'm just doubling 15 right there. Remember, Mark said that 22 was a reasonable PE, and when I do my zoning right here, if I add these two numbers together, I get 42. Divide them by 2, I get 21. And that's the average PE that I've chosen going forward, 21. Again, very close to Mark. And I should be getting a PAR that's very close to the Manifest PAR, a little bit on the slower side because I use slightly lower numbers. And in fact, my PAR of 16 is a little bit lower than Mark's PAR of 20. I go back and take a good hard look at the lines. I don't see anything not to like in the lines or the projections. I've knocked off all of this data here because the company only became public in 2008. So all of this other data is pre-public trading, and I'm going to focus on what the company has done in the years that it's been publicly traded. Now, if you're a better investor, you start to look at some of the standard documents. So here I am going to Scottrade. That's where my broker happens to be for some of my accounts. And I'm calling up an S&P report, and I'm not getting a very helpful S&P report. This is a truncated report. It's giving me a little bit of information, a couple of numbers off to the side, but for the most part, I'm not getting a whole lot of extremely useful information from the S&P report. When I look for a dialogue, I don't find any real dialogue that's specific to IPCM. And even when I go to the next sheet, the second page, I get a little bit of stock performance graphs right here. Shows IPCM doing better than the S&P and doing better than healthcare services. But again, nothing really specific. I get a little bit of information about buy, hold, sell, noticing that the brokers are in the buy-hold range, a little bit of insider information, but again, no real dialogue of any kind. Another of my standard sources is Value Line, so I go to Value Line, and I don't get a regular Value Line sheet. I get one of these smaller sheets for Value Line, and when I look over here, this is in the small and mid-cap edition, and when I look over here, I don't have very many projections in any meaningful way. I do get a 2012 earnings per share projection and a 2012 PE projection, but that's the only projections that I get on the Value Line sheet. The rest of the information is historical data. Again, there's those 4 years of publicly traded history. And I do get a factual thumbnail of the company, but nothing really in dialogue that I'm used to getting as a standard source. One more place that I try, I go to my local library, whoops, and I don't get manifest at my local library. What I get is Morningstar at my local library, and I've gone and I've called up IPCM and I've clicked on Stock Analyst, and unfortunately, besides a price and the company name, I'm just getting a stock answer that says there is no analyst report for the company. That means that I have to start to really work to come up with an analysis for the company. I showed you last time I presented the company that my next step would be to go to the company website and search for some company presentations, and then I begin to read. All the reading that I've done about this company, and there's not volumes written about IPCM, but all the reading that I've come across is fairly optimistic about the prospects for this company going forward. I think I've done a conservative SSG with reasonable numbers, and I think that I have a better than even chance of looking at an investment that will outperform the market in the next 4 to 5 years. That's my addition to the portfolio. I'm just going to double down on IPCM.
Good stuff. And keep in mind that we did feature the company. If you, in fact, Ken, can you go back to the Manifest Investing screen and we can demonstrate something real quick before we turn it over to Hugh? For his rapid slide display on Walgreen. If you go back to the top of this page, Ken, I just wanted to demonstrate we kind of have our own little embedded seeking alpha that stays just with Manifest Investing. If you click on the little hourglass next to any of the company names here, it'll take you to company-specific stuff. And in this case, you see an article at the very top there, the one where we selected it for the monthly newsletter back in October, and then some forum posts on the company. So that could be part of your reading and doing research also It's a company that has kind of caught our attention here over the last couple of years, and it kind of reminds me, and hopefully it'll work out equally well to the fairly early discovery of quality systems a little while back. You can see there we've got some commentary on the company and a little bit of background, but it's in the Solomon Select tracking portfolio for our monthly newsletter. So that's just an example of one other place to get information. I don't see any questions. The board is clear, although one of our attendees pointed out that RIM was down 7 or 8% in after-hours trading. So we're going to throw him out of the room. I'll figure out who he is. He's a goner. But if you're
just adding insult to injury.
I know, it's like rubbing salt in my wounds. And we can switch to Hugh if you're ready.
Sure.
Hugh, do you want me to run slides for you for a while, or do you want to take control from the start?
No, that's fine. You can run them.
Okay, we'll go back and grab the PowerPoint then. We'll have Ken discover who that person was that's bad-mouthing Research in Motion.
Well, I did. I discovered who it was.
Don't name any names.
I even know him. So
one of your mid-Michigan troublemakers, huh?
No, not anybody from anywhere near the state of Michigan.
Oh, okay. All right, well, go ahead and take it away, Hugh. He's going with a repeat selection on Walgreen, and only he's going to come at it from a slightly different wrinkle because it is been repeated several times in the roundtable portfolio.
I think this might be the 6th or 7th. I'm not sure.
Yep.
Yeah. So I'm going to add Walgreen again. Here is an SSG not done by me of the company. We have 2 years, I think, of projected sales. The historical growth rate is about 7.9%. I have a much more optimistic 11, but I'll get into that on the next few slides. So I'm going to go through it again, look at some recent news, take a gander at the stock selection guide. I'm also going to touch on the fact that it has a direct stock purchase program, like about 400 or 500 other companies, and a dividend reinvestment program like 17 or 1800. So we'll touch on that quickly. And then dig into the return on equity and why I like what I see. So first of all, on the next slide, we just touch on recent news. And the fact of the matter is that it had a little bit of a tiff with Express Scripts. And as a result, its sales have been hurt. Sales have dropped. And not only the sales of prescription drugs, but all of the other things in the store that people might buy when they're coming to fill the prescriptions, that has been hurt as well. And a number of people have commentated on that. The fact is, it's still a very solid company. It has underlying growth. I think it will ultimately kiss and make up with Express Scripts. That's my opinion. But there are a lot of indications that that's in the offing, and it's to the benefit of both companies, really, to do that. I was teasing Mark earlier that if you look at some of the companies in the space, Rite Aid being an example, it's a blighted company, not doing well, not in a very strong position to negotiate with a company like Express Scripts. Kind of everyone is brought down by that kind of problem that a giant in the industry has had for the last 5 or 10 years. Walgreen's a much higher quality company, but it has to take what the market is shoving in its face right now, and Express Scripts is the proverbial 800-pound gorilla. On the next slide, we look at the assumptions that I made going into the SSG. I'm not afraid to admit that the 11% sales growth target is extremely aggressive. I'm not going to go in great detail as to why I think that's possible, because I think we've talked about that a number of times. Pre-tax profit margin of 5.5% is on track, as is the tax rate. I'm being conservative about the number of shares outstanding, but I come up with a projected EPS closing in on $5, slightly above what analysts are saying, although analysts have recently downgraded it a little bit. On the next slide, we look at the part 1 of the SSG. We can see the company got whacked a bit in the Great Recession, 2009, 2010, but is back on track right now as to the sales and earnings as to the growth rate that it had before. It's slowing down a little bit, I'll admit that, because of the issue with Express Scripts, but I'll echo again the opinion I have that this is a temporary issue that will resolve itself. Both companies are looking for a solution, I am sure. The next slide, we look at part 2 of the SSG, looking at the pre-tax profit on sales, and part 2B, the return on equity, one of my favorite parts of the SSG, and we'll dig into that a little bit more, as I said, as we come back. You can see clearly there that bad things happened in 2009 and 2010. By the way, the fiscal year ends in August, so it's off a little bit. But the fact of the matter is that the pre-tax profit on sales took a nosedive, and now it's back on track again. And in fact, if you discounted those 2 years as being exceptional, and fingers crossed, never would occur again, you'd still have an even behavior for the long-term trend. But the fact is that it is steady, and the ROE is improving. The next slide, we look at part 3, where we're digging into the PE ratio. And again, this is a bit of a challenge, because with PE, you're really at the mercy of the market overall and what other people think the valuation of the company should be. Now, the question is, do you pick a PE based on what others are going to do, or do you pick a PE ratio that it would be comfortable for you, that you could live with? I generally do the latter more often, but I will push it up a little bit if I think people are going nuts out there. But right now, I think if you pick one that's comfortable for you, you kind of minimize your downside, and better still, increase your upside. And then using those numbers on the next slide in part 4, you end up with a company that is very clearly in the buy zone. I've conservatively chosen the PE ratios as 15 and 10 for the high and low respectively. You end up with a projected price well over 70, and a whopping great upside-downside ratio of 8 to 1, 8.1 to 1, which might make you a bit nervous. But part 5 of the SSG that follows shows then that the projected annual return down there on the bottom right is just over 15%. Includes the effect of stock price appreciation and the annual dividend. And then if we skip to the next slide, we can look at what Manifest projects, and there you have a projected annual return of 15. So I started off with kind of a wacky number for projected growth in sales of 11%, whereas Manifest, using more consensus estimates, come up with about 5.6. But we end up with the same par. So I guess my optimism for sales is tempered by conservatism and some of the other judgment calls that you make when you create a stock selection guide. And then on the next slide, we'll just take a peek at what has happened in the past, where Walgreen has been. We can see the projected annual return is dropping, but I still think there's a lot of life in this animal. So I'm picking Walgreen, but moving forward, I just want to bring your attention to the website. We're not going to do this live, but if you scroll down to the bottom of walgreen.com, a lot of menu items down there, but one of particular interest is the investor relations, the link to the homepage. When you click on that, you see something like what will appear on the next slide, detailing all of the different things that the company has to offer its individual investors. And one of the nicer things to get is the fact book, which they update, I think, quarterly. And I'm going to upload that to the Manifest Investing website. It's a PDF document. It'll link at some point to the thread that's created on this discussion, so you can get that there as well. If you click on stock information, you get something that looks like this. And one of the things that always catches my eye is that the company has a direct stock purchase plan. And when you click on that, you get to a page where it just tells you they have one, which is on the next slide, but doesn't give you more information. But if you know how to get to the Wells Fargo site, I believe this one is shareowner.com. I could be wrong about that, but I'll provide the link. You get a page, not quite like this. I've scrolled down to the bottom where you see you can click on a list of either companies that will sell you a share directly through the transfer agent, or if you transfer a share from street name to through the direct stock registry, you can participate in the program that way. For those of you, by the way, that have a TD Ameritrade account, you can reassign 4 different shares per year without charge. So if you ever wanted to join these different programs from a TD Ameritrade account, if you have at least one share, it's pretty easy to do. So when I clicked on the direct purchase plan link, there's about 120 to 130, well, it looks like there's 75 or so, but there's about 1,000 altogether, or 700 on this site that have dividend reinvestments. One of them is Walgreen, and a link there, walgreen.co, when you click on that, it gives you a list of the 4 different brochures or other investor information that might be pertinent. The most relevant one for me is always the brochure, which I always take a gander at to see what their fees are like. It's a PDF document, and there's an outline of it on the next slide. And it's usually a pretty standard format where it goes through lots of details about direct stock purchase, optional cash payments, etc. Right down at the bottom, there's a section on fees. And for many companies, some companies, like RPM is a good example, there are no fees. Schwab, funny enough, no fees. Walgreen has fees, and I've reproduced the fees page here, where it costs you $10 to enroll, but if you have an account at TD Ameritrade, you can get that done for free. Other things are paid by the company. Some companies actually charge a few cents to reinvest dividends. I don't like these programs with loads, but this one charges $5 for an optional cash payment. That's somewhat hefty in my book because there are brokers that will charge $3 for a transaction. There's a few of them. There's one just to trade that charges $2.50. So this is somewhat high, but the fact is if you're a club or if you're an individual that prefers to use a broker like TD Ameritrade or a Schwab, this might be another option. And you can always ACAP the shares or have them transferred over to your account when you're done, when you've accumulated enough shares. So moving on to the next slide, I just want to talk about the return on equity because people often skip over this part of the stock selection guide, and there's really a wealth of information embedded in here. And George Nicholson obviously put it in there for a reason. He put pre-tax profit on sales and return on equity together for a very good reason. And it echoes back to a thing called the DuPont analysis that this company used when it was variously trying to buy other companies or analyze other companies. And it chopped the return on equity into its drivers. There are 5 actual components in the way DuPont does it. One looks at its tax, but in the way I'm going to do it here and the way many others do it, it's really broken into 3. One that measures profitability, one that looks at how well it uses its assets, its operational efficiency, and then how the company is capitalized to the extent that it's leveraged. One of the drivers will illustrate that. And if we skip on to the next slide, we all know that the ROE is earnings per share over book value per share, a very easy calculation from data that comes from Value Line. But of course nowadays the per share issue can be a bit confusing because earnings is often reported, I guess earnings are reported, on a fully diluted basis. So very often it's probably a little bit easier just to pull off net income and divide that by total shareholder equity. So you kind of get around any squirrely ways that there might be accounting for the number of shares outstanding. But you can actually carve it up quite simply. I mean, the rule is if you multiply anything by 1, you get the number back again. And if you look at the third line, which looks a bit mathy, but it really, all you're doing there is you're divvying up the ROE, you're multiplying it by sales divided by sales, and assets divided by assets. But you're just divvying it up in a way that you can divide ROE into the product of 3 separate ratios. Net income divided by sales, well, that's actually a measure of profitability. The more income you get per sales, more money you're keeping, the more profitable you are. Sales divided by assets, it's kind of a measure of efficiency. How many dollars per year are you getting from your assets? It's an annual calculation. It's comparing something on the balance sheet with something in the income statement, but it's looking at efficiency. And finally, looking at assets divided by equity, 2 things in the balance sheet, you're looking at the extent of leverage. If you have no debt at all, that ratio becomes 1. If you have a lot of debt, if your company is funded almost entirely by debt, that ratio becomes very, very large. And so your ROE can actually be increased if you're a highly leveraged company. It can be decreased if you're an inefficient company or not a very profitable company. So you're looking at a ratio of 2 things on the income statement, a ratio of something on the income statement, the balance sheet, and a ratio of 2 things on the balance sheet. And multiplied together, they give you the good old faithful ROE. By the way, if you divide net income by 1 minus the tax rate, you've got pre-tax profit divided by sales. The point being that pre-tax profit on sales is embedded somehow into the ROE. So those two things should track, and if they're not tracking, it's never a bad idea to chop it up into its components to see why. Either the company has acquired another company and taken on debt, so that third component has gone squirrely, or something's gone wrong with how efficiently it's using its assets. There's always a story there, and it's something that I tend to do. If we skip on to the next slide, it's just illustrated a little bit more how, ROE divided into those three components is it's the same thing. You've just got sales divided by sales, assets divided by assets. Now if we move on to slide 46, I know this is a little bit like a movie, but the summary here is that for profitability, higher is better. But the fact is, for both profitability and efficiency, there are usually limits in a given industry. There's a roof, a ceiling. And the company that's closest to that ceiling is usually the best. And then, of course, companies have choices about how they finance themselves. So companies can decide to take on a lot of debt, and that can be a driver for the ROE. And it can artificially bump a company up. It can make it look a little better, a naive first pass of what the ROE is all about. I always check to see if I see a nice trend in ROE. I want to make sure that it's coming from profitability and the efficient use of assets, and not something that's happening on the balance sheet, increasing leverage. Move on to the next slide. You can get all the information you need to carve up the ROE on moneycentral.com. You click on the 10-year summary, which is when you click on a ticker symbol, you're brought to kind of a first screen which gives you the quote, but over on the far left there's a link to a 10-year summary, and if you click on that, you get information from the income statement first and then from the balance sheet. And the information you need to extract is the sales information, the net income. I take earnings per share, but you don't really need that, and the tax rate. And if you move on, if we go on to the next slide, 48, the information you need, got messed up a little bit, but you just need the current, assets and liabilities. Now, by the way, it turns out it's labeled wrong. It has been for some time on Money Central. I've pointed out to them that current assets is kind of a term of art in accounting. They mean that it's I think they mean it's the current situation of the total assets and the current situation of the total liabilities. But that number for August 2011 of 27.45 billion isn't current assets as you would define it on a balance sheet, it's total assets. And you remember 27.45 and go to the next slide just to reassure you, you can see that you've got the balance sheet information here, and if you scroll down to the bottom you see it's $27.45 billion. It is the total assets. And you need total assets and total liabilities to carve this thing up. You can do other things, but this is what you would really need to carve it up.
That's amazing that they haven't.
What's that?
Excuse me, but that's amazing they haven't fixed that.
No, it really is. I know what they mean, because when I got an email back saying we mean the current situation of the total assets, I said fine, but it's a little bit deceptive. And somebody that's just like the first time I looked at this some time ago, I said, I wonder why they're putting current assets there. I wish they showed total. Sure enough, they do show total. And then we bounce on to the next slide. This is just an Excel spreadsheet. Over on the left, you see the numbers that I extracted, more than I needed actually, but I extracted from moneycentral.com. And then on the right, the columns that are labeled in blue is where I did the calculation. That first column is pre-tax profit divided by sales. That's part 2A of the SSG. And then the others are the three drivers of the return on equity. So you can see that the three drivers of part 2B. And in 2011, the very first line, you can see that the profit margin was 3.8%, 0.038. The efficiency was 2.6, and you can see for many companies that anything over 1 is generally good. And this company has leverage, and you can go from the bottom, which is 2002, up to the top, which is 2011. You can see that Walgreen has been increasing its leverage gradually over time. You can see that it used to be a lot more efficient with its assets in the past. Now, the asset mix has changed, and the things that it's doing have changed as well. But that's something to monitor over as well. And we saw previously that 2009, 2010 were both kind of bad years, and that's reflected in the lower profit margin. But it's now back on track to the profit margin that it had in the past. Now I want to go on to the next slide where we can look at another company in the space, this one's CVS. Here you can see maybe arguably a slightly better profit margin. You can see also a decline in the efficient use of its assets. It's producing fewer sales per unit asset over time, just like Walgreen. But the other thing is that maybe the company is not as highly leveraged. But if you go back to the Walgreen slide, you can see that Walgreen is much more efficient with its assets than is CVS. They're both trending down, but they're much more efficient. Walgreen is more efficient. And it has overall a much higher return on equity. The part that the shareholders own, free and clear, if you will, that there's no contingent liability on the other side of the balance sheet, no debt that has to be paid back. And then the next slide, just comparing it with kind of a gold standard, if you will, I'm looking at Walmart here. Now, again, it's in the retail space, so you don't expect profit margin to be super, and it's 3.5%, 3.6%, never got up to 3.8 like Walgreen did. But it's using assets pretty efficiently, maybe not as efficiently as Walgreen does, certainly more efficiently than does CVS. And note that it has a higher ROE, and that's in part driven by the fact that it is more leveraged. And there's nothing wrong with taking on debt. In fact, nowadays it's cheap to take on debt, so it might be a cheap way for a company to increase its ROE, return on the shareholder equity. Since a company like Walmart can probably borrow at very low single digits, people are pretty confident that Walmart will pay the money back. Rite Aid's a different story. It's not here. And just two or three other comparisons. The next one I'm looking at Whole Foods. That's a company that's been on a tear. I think it's up 800% the last 2 years or so, 2 or 3 years since the Great Recession. But again, its profit margin is no great shakes. It's just right where the other companies are. Its return on equity is no great shape either, but it's doing really well with its assets. Now, it's trending down just like other retailers, but it's doing quite well. And it's not as leveraged as some of the key players in the industry like Walmart. And in fact, you can see a trend here from 2007, 2008, where I think there was a merger in that time frame. But it's paying off its debt, and its leverage is decreasing over time. And then skipping on to the next one, I wanted to look at Express Scripts. Again, this is a company, if you go down to the bottom, we're looking at the fiscal year that ended in December of 2003, where the profit margin was 1.6%, and it has improved greatly up to 2.7% recently. It was 3.5% at one point. It's making quite good use of its assets. The ratio is much higher than any other companies we looked at. But interestingly, it's very leveraged compared to everyone else in the space. And obviously, in 2011, something happened, and you go back and it's usually a merger or an acquisition that drives that number from, well, it's pretty high anyway, 2.9, but this time it doubled up to 6.2. So it's taken on significantly more debt, but it has a very high return on equity, driven in part by leverage. And the final one I'm looking at, just so you can see that different spaces have different behaviors. Amgen is not related to the other companies at all, except for the fact that some of its prescription drugs at some point might be sold through Walgreen, but it's significantly more profitable. And when you see profit margins like that, you immediately know a company doesn't have serious competition. And if you look at Apple, Apple's profit margins are growing dramatically. It's always a good sign when this is happening, but it usually actually triggers competition. It's a little bit different in the pharma industry, but in most other industries, high profit margins go away over time as competitors come and try to take the funds away. The sales actually aren't as efficient as other industries, but this is characteristic of the pharmaceutical industry, where you're extracting fewer sales from your assets. And the other thing, of course, in the pharma industry is a lot of those assets are intangible. Copyrights, other kinds of intellectual property on the balance sheet. And this company, like any company that moves from a growth phase into a more of a mature phase, takes on more debt, so you can see that the leverage ratio is increasing over time. If it had no debt, that number would be 1. As you increase the amount of debt on your balance sheet, it increases gradually, up as high as 7 or 8 that we saw for Express Scripts. But this is just a very useful way I've always found of carving up the ROE and looking at what's really going on with the company, what's really driving it. And you sliver it up into smaller sections and look at the tax behaviors, etc. But I don't like to do that. I think these 3 drivers are enough. And you can see George Nicholson's genius in separating out the pre-tax profit margin on sales as well, so that you can really see if those 2 things are moving together. And if they're not, you know, it's worthwhile often carving it up to see what's going on. So I think the final slide is just a summation, the summary for Walgreen. The tiff that it's having with Express Script is really dragging this stock down. I think this problem will be resolved. It's in both parties' best interests to fix it, and business people always find a way of fixing problems. That's what they're in the business of doing. The conservative analysis that I showed, except maybe for the sales growth, comes up with a PAR of 15%, which is in agreement with the key players in this industry, i.e. manifest investing. Company pays a nice dividend, which is always nice to see, and when the price is low, the yield is better. And it's now actually in a few percentage points of its 52-week low. So sorry I ran over, but the selection for me for this week is yet again my old stalwart, Walgreen.
Thanks, Hugh. Any questions from the audience, Ken?
No, Mark, we're pretty clear on the question box tonight.
All right, we're just a little over. I thought it was worth digging into that a little bit. It's a type of subject that if you'd like to see more on, just let us know. And I find it kind of fascinating. I don't typically drill that deeply into return on equity, but certainly had me doing some numbers, crunching off on the side here as we toured through those. So thank you, Hugh.
Yeah, you're welcome.
All right. Just a couple other things to bring to your attention, and there's a mailing address for it if you do have any suggestions on topics or whatever. We will be having this event again about a month from now. We'll be out with a date here shortly. But I also wanted to make you aware that there are a few events out there that have been recorded recently, including Hugh's discussion on the pharmaceutical pipelines, the FDA approval process, and that kind of stuff that is available as a YouTube recording. So if you go to the event tab at Manifest, you can do it even if you're not a member or a subscriber, and take a look at those presentations under events. They are archived there.